On today's video, we're going to talk about exactly what affects your credit. There are so many myths, so many beliefs, and I want to get right to the point so you understand exactly what affects your credit, because we know that in today's time and age, credit affects pretty much majority of every aspect of our life, where we live, your life insurance, your car insurance, even your job. So let's get straight to it. Let's actually understand exactly what affects our credit. So if you don't know, if it's your first time joining us, my name is Brian Otieno. I'm founder of Pennington Consulting Group, and over the years, we've helped thousands and thousands of entrepreneurs and business owners just like yourself get access to capital, grow their business, start their business, or even build business or restore personal credit. So in this video, again, I just want to kind of take a moment here and discuss a little bit about what really affects your personal credit. There's so many myths, there's so many beliefs. Some people think just, paying their rent on time will make sure that they have good credit. Some people think that they, since they pay things in cash, that they should have good credit. And these are the things that I kind of want to clarify today on today's video, to kind of just help you understand exactly what are the credit bureaus looking for, what do they use in order to actually evaluate your credit score, and how to always maintain good personal credit, okay? So now, a little brief history. We should all know that there's three major credit bureaus. There's tons and tons of them out there, but the three major ones that most lenders use to evaluate risk is TransUnion, Experian, and Equifax. Now, why do lenders use these credit bureaus? I just told you there. They use the information held by these credit bureaus to evaluate risk. When you're going out there and you're shopping for a personal loan or a car loan or a mortgage, the lender needs to verify a few things. They need to make sure that you're actually able to handle the payments, if you're going to be a good candidate, if you're going to be a good fit for them to actually lend you these monies. So one tool that they use is credit, the information being held on your credit. Now, what information is being held on your credit? A credit report has, of course, your name, your address, your date of birth, things that identify you personally. In addition to that, they also have your trade lines. Your trade lines are all the different accounts that you've opened in the past, at least the past 7 years, because any information in your credit report can only be held for 7 years. So your trade lines, I'm talking about your auto loan, your student loan, your mortgage loans. It also has your payment history with all these accounts. And based on this information, a score is generated. This score ranges between 350 to 850. And based on your score, the higher the number is, that means you're low risk, and the lower the number is, that means you're actually high risk, okay? So now, let's quickly go over exactly the 5 things the FICO score uses in order to evaluate your credit score. So number 1, 35% of your credit score is based on payment history. What does this mean? This means actually making your payments on time. But in order for you to benefit from this 35% to what FICO evaluates, you have to have some type of trade lines that you're making payments on. The reason I'm emphasizing on that is, for most people that think that since they pay things in cash, they should have a good credit score. It doesn't really work that way, okay? In order for you to benefit from this 35% to what FICO evaluates, you have to have actual trade lines, accounts, loans, student loans, something that is being reported in your credit report that you're making payments on every single month on a consistent basis for you to benefit from this 35% of what affects your credit score. Now, the next thing, 30% of your credit score is based on your utilization percentage. Utilization is balances in relation to limits on all open revolving accounts. Now, the key word there is revolving accounts, okay? So that means credit cards. If you do not have any credit cards, I'm sorry, you're not gonna have a good credit score, because again, 30% of your credit score is based on your utilization percentage. Balances in relation to limits on all your open revolving accounts. Let me make that make sense. So if you have a Capital One credit card with a $1,000 limit and a $500 balance, that means you're 50% utilized, okay? So now, what lenders tend to calculate when it pertains to utilization, how much of your available credit are you using? If you're using close to the limit or up to the limit of what your available credit, then you tend to be a high risk. And then you're going to take a hit on that 30% to what FACO evaluates. I always suggest you want to keep your balances below 50%, preferably below 30%, or what the available limit is. In addition to that, I always recommend that you request a limit increase once every 30 days. The higher the limit are, the better off you can play with this 30% rule that I just told you. So now, moving forward, 15% of your credit is based on types of credit, the different types of accounts you have, the different trade lines, auto loan, student loan, personal loan. These are the different types of trade lines you have. And 15% of your credit is based on your diversification, if you want to call it, of the different accounts that you manage on your file. The more different types of accounts that you have, the better you'll benefit from this 15% to what FICO evaluates. Now, the next thing is 10% of your credit is based on age of file. This is not how old you are, but this is how old your credit profile is based on the oldest item reporting on your file, okay? So again, that's why I always suggest, especially with parents, start building your children's credit history early. Today, I think you can get a credit card as early as 13. Okay, so start building your children's credit history early. So in the long run, they can be 18, 19 years old and quickly start managing and being able to stand on their own as it pertains to their credit. So it's always advised to start building your credit. The earlier, the better. Because again, 10% of your credit is based on age of file. And lastly, we have 10% of your credit, which is based on inquiries, okay? Or how much new credit that you've had within a specific time period. That's why I always suggest, and you probably heard it before, having a lot of people pull your credit or different inquiries or shopping around for credit too within a short period of time is probably not beneficial as it pertains to your credit. So again, 10% of your credit is based on inquiries, how much shopping you've been doing. And there's this old joke that I always say, banks only lend money to people who don't look like they need money. So if you have a lot of inquiries on your file, you look desperate, okay? And it's actually going to affect your credit score. So now, let's summarize it real quick. 35% of your credit is based on payment history. 30% is based on utilization, which is credit cards. You must have credit cards. 15% is based on types of credit, okay? 10% is based on age of file. And lastly, 10%, the fifth factor, is based on your inquiries, okay? There's another video that I talk about how to manage each one of these factors so you can better understand how to always maintain a higher score. I'll probably leave a link in the description below. But hopefully you've gotten a better understanding and I've cleaned up all those myths out there on actually what affects your credit score. And you'll be able to actually look at your personal credit and understand what you need to do in order for you to actually maximize and increase your credit score. So anyway, I appreciate your time just like always. If you do like this type of videos, please help us grow this channel by liking the video. Do subscribe to our channel. Leave a comment down in the description below. I am giving a free copy of my book, and there's actually a bonus chapter on that book that I talk in detail about this specific topic we just covered today, the 5 factors. I go much deeper as to what they are, how do they affect your credit, and again, how to manage it, okay? So you can always make sure you have the highest credit score so you can get the best terms, best loan option there is out there. So click a link in the description below to get a copy of that free book. And again, as always, I appreciate your time and you have a good rest of your day.